Last week, we talked about foreclosure. And at the end of that conversation, we mentioned 2 ways out before it completes: a short sale, a deed in lieu. And if you listened to that episode, your first thought probably was, okay, so how do I actually do that? Tonight is not a recap of last week. Tonight is what happens when you actually try to walk through those doors. Because knowing an option exists and knowing what happens when you try to use it, those are 2 completely different conversations. The servicer that puts you on hold for 45 minutes and then tells you to call back. The approval letter you finally get after 4 months of calling every week that has 1 sentence in it, that reserves their right to come after you later. The form that arrives in January from a lender you thought you were done with, telling you that the $70,000 they forgave you is now being reported as income. Your income. Money you never saw. Tonight, we go inside what nobody tells you about what actually happens when you try to exit. Welcome to the Real Credit Talk Show, audio edition. I'm your host, Tiana Mayers, also known as Lady T. Founder of Beyond Credit Limits Corporation. And this is where we break down how credit actually works. Not from opinion, not from guesswork, but from how the system is designed to read you. This is a Beyond Credit Limits production. If you want to understand how your situation connects to what we talk about here, you can visit www.beyondcreditlimits.com. And if you've been tapped into the brand, you already know what it is at thatmerchmood.com. This is a space where we stop repeating credit myths, stop chasing surface level advice, and start breaking down how the system actually works. Not the watered down version, not the social media version, not the version people throw around without context. The real version, the structured version, the version that helps you understand what is actually happening when your name, your information, your accounts, your behavior, and your decisions all come together inside a credit profile. So wherever you're listening from, I want you to settle in, because this conversation is not just about credit. It's about how your profile is being read before you ever get an answer. Now let's go. Tonight is not about your credit. Let me say that again. Tonight is not about your credit. Tonight is about a relationship that you thought was over, but the other party never got the memo. Think about that person you broke up with who kept showing up, who kept calling from different numbers, who told mutual friends they were fine while sending you letters through an attorney. A mortgage you can't pay anymore is that relationship. You made a decision to leave. You told them. You thought it was done. But the lender has a process. And that process has timelines. And those timelines have consequences. And none of them care that you've moved on emotionally. Tonight, we talk about what actually happens when you try to walk away from a mortgage strategically. Not the theory, the experience. Let's go. Welcome to episode 18 of the Real Credit Talk Show. 18, y'all. I'm Tiana Mayers, Lady T. And last episode, foreclosure. We talked about what happens when the process runs its course. And at the end of that conversation, we name two alternatives that can change the outcome. Short sale, deed in lieu. Tonight is not a repeat of that. Tonight is what happens when you try to actually use one. Because here's what nobody tells you. You don't just decide to do a short sale and it happens. You don't just call the lender, say you want a deed in lieu, and get an answer by Friday. What you actually get is a process that moves at the lender's pace, with the lender's requirements, on the lender's timeline, while your life is on hold. And inside that process are moments that most people don't see coming. Moments that determine whether the exit actually closes the chapter or leaves something behind that follows you. Tonight, we go through those moments. We'll be right back.
Most people think credit is just a score. It's not. Your credit can affect where you live, what you drive, your interest rates, approvals, deposits, business funding, and even the opportunities available to you. At Beyond Credit Limits, we help consumers understand how the system actually works. This isn't about gimmicks. This is about structure, strategy, education, and financial positioning. Whether you're trying to rebuild, organize your financial profile, understand collections, prepare for home ownership, or create a stronger financial foundation, Beyond Credit Limits was built to help you move with intention. The consultation is where everything starts. We review your situation, identify what's happening inside your credit profile, and map out the next steps based on your goals. Stop guessing, stop moving blind, and stop letting misinformation cost you financially. Visit www.beyondcreditlimits.com and fill out your consultation today. Again, that's www.beyondcreditlimits.com. Beyond Credit Limits, because financial freedom starts with understanding the system.
And we're back. Let's get into it. You know what a short sale is. You know what a deed in lieu is. We covered both last week. What we didn't cover is what it feels like to be inside one. A short sale is a negotiation. But here's the part people miss. You're not negotiating as equals. Think about it like this. Imagine you wanted to end a business partnership, but the other partner gets to decide whether the partnership ends, on what terms it ends, how long the process takes, and what you owe them when it's over. And while you're waiting for their answer, the consequences of not having an answer are piling up on your side. That is a short sale. You bring a buyer. The lender evaluates whether your buyer's offer is worth more to them than completing the foreclosure. They order a BPO, a broker price opinion, their own independent assessment of what your house is worth. And if the buyer's offer doesn't match what the BPO says, they decline it. Months of waiting, One-word answer: start over. Meanwhile, the foreclosure date is still on the calendar. And a deed in lieu, think of that like trying to return something to a store that doesn't do returns. You walk in, you say, "I want to give this back." And they say, "We'll look into whether we accept that. Come back in 60 days. The difference is a deed in lieu removes the buyer from the equation. It is just you and the lender. One negotiation. One party whose agreement you need. And in that negotiation, you have something they want. Your corporation. Your willingness to walk away cleanly saves them the cost and time of a foreclosure. That cooperation has value, and value can be negotiated. Most people never negotiate. They just sign whatever lands in front of them because they are exhausted and they want it to be over. And what they sign determines what follows them. Here's a scenario. You bought the house. A few years later, you pulled a home equity line. Maybe for repairs, maybe for debt, maybe for something else. Whatever the reason, it made sense at the time. Now you're trying to do a short sale. The first lender approves it. The buyer is ready. The closing date is set. And then the whole thing stops because nobody told you about the second lender, the home equity line, the second mortgage, the junior lien on the title. In a short sale, the first lender gets paid first. By the time they take what they're owed, there's often nothing left for the second lender. And for the sale to close, the second lender has to agree to release their lien. Now you have two negotiations running simultaneously. Two lenders, two timelines, two parties who both have to say yes before anything happens. Sometimes the second lender agrees. Sometimes they don't. And sometimes, and this is the part that catches people completely off guard, they agreed to release the lien while reserving the right to sue you for the balance. The sale closed. You exhaled. You thought it was over. And 18 months later, there's a letter from a law firm about a balance you thought was gone. It wasn't gone. You just didn't read the approval letter closely enough to see the sentence that kept it alive. The approval letter is not a formality. It is a legal document. And the difference between all claims released and silence on the remaining balance is a difference that can follow you for years. The short sale closed. The deed in lieu was signed. You moved. You started over. You told people it was behind you. Then January comes and there's a form in the mail, a 1099-C from the lender for $70,000. And you stare at it. You read it like 3 times. You assume it's a mistake. It isn't. Here's what happened. You owed $280,000. The house sold for $210,000. The lender forgave the $70,000 difference. And in the IRS's view, that $70,000 in forgiven debt is income. Because you were relieved of an obligation you would otherwise have had to pay, money you never received, taxed like you earned it. People have received 5-figure tax bills more than a year after they thought the chapter was closed. Not because they did anything wrong, because nobody told them this was part of the exit. Now, there are exclusions. The Mortgage Forgiveness Debt Relief Act has provided protection for qualifying situations on primary resident mortgage debt. And if your debts exceeded your assets at the time of cancellation, an insolvency exclusion may apply. But these are not automatic. They require the right filing, the right documentation, and a tax professional who specifically understands what canceled mortgage debt means at tax time. The conversation with that tax professional needs to happen before the exit closes, not after the 1099-C arrives. Because after is too late to change the filing. After, you're just responding to a bill. Most people go into this process asking for nothing because they don't know what's available to ask for. Let me tell you what it is. The deficiency waiver, this is the most important line in any short sale or deed in lieu agreement. 4 words, all claims released, or deficiency hereby waived, or settled in full. If you don't see language like that, the lender kept the right to come after you later. Silence is not a waiver. Silence is a reservation. Every lien holder needs their own written approval, not a verbal agreement, not an assumption, a document with specific language. Relocation assistance. In some situations, especially deed in lieu, the lender or servicer will offer cash to help you move. Not because they're generous, because a cooperative exit costs them significantly less than an uncooperative one. Your corporation has a dollar value. Most people hand it over for free because they never thought to ask. Ask in writing. The answer might surprise you. How the account gets reported to the bureaus. In a deed in lieu specifically, some lenders will agree to report the account with more favorable language than what would otherwise appear. Not foreclosure, not deed in lieu derogatory. Something that reads as a resolved, negotiated account. This doesn't always succeed, but it costs nothing to ask for in writing. And the difference in how that notation reads to the next lender who pulls your file can be the difference between a conversation and a decline before you get to have one. The move-out timeline. A deed in lieu can move faster than people expect. Negotiate a timeline that gives you enough days to actually figure out where you're going next. Because the worst time to find out an apartment is when you have 60 days to be out of a house. Every one of these things has to be in writing before you sign. Not discussed on a call, not assumed from a previous conversation. In writing, in the agreement, before your signature goes on it. Because the document you sign is the only version of the truth that matters afterwards. Here's what a lot of people assume. If I do a short sale instead of a foreclosure, my credit is basically fine. That's not quite right. Both a short sale and deed in lieu are significantly negative entries. What they are not is a completed foreclosure. And that distinction matters to future lenders. But it does not mean the damage is small. The late payments that happened on the way to the exit, they're still on the file. Every missed payment is its own notation. The account itself closes with a notation reflecting the exit. And the clock that determines when all of it comes off runs from the date of first delinquency, not from when the short sale closed, not from when the deed was signed. The clock started the month you missed the first payment, which means by the time you execute the exit, the clock has been running for a while already. Here's what that actually means for the next home. A short sale or deed in lieu typically produces a shorter wait than a completed foreclosure. We talked about the specific years last week, but the number of years is not the only thing that matters. What you build during those years is what determines whether you qualify when the window opens. Because the waiting period ending does not mean the lender stops looking at the file. It means the mandatory disqualification period is over. They still read everything that's there. And if what's there is 2 years of late payments, new collections, and nothing positive, the waiting period ending changes nothing. The waiting period is not the finish line. It's the starting gun. What you build between now and then is the race. If tonight connected to where you are, if you recognize your situation in what I described, do not let that feeling sit. Visit www.beyondcreditlimits.com and fill out the consultation form. We look at the full picture, every entry, every timeline, every goal, and we build the strategy around what's actually there. If you have questions for the show, submit it to the Real Credit Talk Show at beyondcreditlimits.com. Your first name, end state, or anonymous. Your choice. I read everyone. Let's get into tonight's questions. Lachey, Connecticut. Lady T, I did a short sale 2 years ago. I just pulled my credit and the lender is reporting it as foreclosure, not short sale. I've been telling people I did a short sale. Does it matter which one it says? Lachey, yes, it does. A short sale and a completed foreclosure are two legally different events. They do not mean the same thing to a future lender, and they're not interchangeable terms on a credit file. If your short sale closed properly, the lender approved it, the property sold, the proceeds were delivered, and the report says foreclosure, that may be a reportable inaccuracy. What you need to dispute it, your HUD-1 or closing disclosure, the lender's short sale approval letter, anything that confirms how the transaction actually closed. The dispute has to be specific, not I don't like what it says. This account closed via short sale. Here is the documentation. Bring that documentation to www.beyondcreditlimits.com and let's look at exactly what's reporting and how to address it. This is fixable, but you have to move on that. Tyreek, Hawaii. I've been trying to do a deed in lieu for 4 months. My servicer just keeps saying they're reviewing it. I'm starting to feel like they're just running out the clock on the foreclosure. Is that possible? Yes, it is. And the fact that you're asking that question tells me you already sense it. Trust that. Here's what you need to know. Servicers have legal obligations under RESPA once a complete loss mitigation application is received. They have to review it. They have to communicate. They cannot run out the clock indefinitely. First question, have you submitted a complete application? Not just expressed interest over the phone. a complete, documented, written loss mitigation application? If yes, and they've been sitting on it for 4 months with no formal written decision, you may have grounds to escalate to a supervisor, to the CFPB, through legal counsel if necessary. Get every communication in writing from this point forward. Dates, names, what was said. Because if this escalates, your documentation is your protection. Miles, Indiana. My short sale was 3 years ago and I want to buy again. My credit union said I have to wait 4 years for conventional, but I've been rebuilding the whole time. My score is 694. Why does the score not just be enough? Miles, I want to answer this honestly because it's one of the most frustrating things about the mortgage world. The waiting period is based on the event, not the recovery. You could have a 750 and still hit the same wall if the mandatory period hasn't cleared. That's not a commentary on your effort. It's a program guideline. At 3 years out, you are 12 months from the 4-year window. What you do in those 12 months determines whether you walk in qualified or walk in eligible. Those are not the same thing. One more question I'd be asking right now is, do you have documented extenuating circumstances for why the short sale happened? A job loss, a medical situation, a specific verifiable event. Because some programs allow consideration at 2 years with that documentation. If you have that, you may already be eligible and not even know it. Visit www.beyondcreditlimits.com and let's look at the full file now so when that window opens, you're ready to walk through it, not scramble toward it. Naomi, Nebraska. I've disputed the same thing on my credit report 4 times and it keeps coming back verified. My cousin said I need to dispute it differently. What does that actually mean? Naomi, your cousin is actually onto something. When something keeps coming back verified, it usually means one of 2 things. 1, the information is accurate, and disputing accurate information repeatedly will keep producing the same result because verified means verified. 2, there is a real inaccuracy, but the dispute hasn't included specific evidence of what's wrong. Please investigate this account. It's easy for a creditor to respond to with a confirmation. This balance is incorrect. Here is documentation showing the actual amount is a completely different conversation. The strategy changes completely depending on which situation you're in. What specifically are you disputing? The account itself, the balance, the date, ownership? That tells me whether there's a real dispute here or whether we need to talk about what the account actually is and what can realistically be done about it. Jasper, South Dakota. I did a deed in lieu in 2021. They told me verbally the deficiency was waived. I signed the agreement without reading every word because I just wanted it to be over. Now in 2024, even though it's 2026, in 2024, I received a letter from a collection company for $38,000. What do I do? Jasper, first of all, I hear you. I just wanted it to be over is one of the most human things a person can feel in that moment. And it is also how people end up in exactly the situation you're in. I get it. Here is what I need you to do right now. Find the deed in lieu agreement you signed. Read every word of the section about the deficiency. What does it actually say? Does it say deficiency waived? Does it say all claims released? Or does it only address the lien on the property without ever touching the right to pursue the balance? Verbal agreements in loss mitigation processes do not override what you signed. The document is the agreement, not the phone call. If the waiver language is in the agreement, you have a defense. A collection company pursuing a waived deficiency is potentially something you can respond to with that documentation. If the agreement is silent on the deficiency, the picture is more complicated, but it is not hopeless. Either way, this cannot wait. Visit www.beyondcreditlimits.com today so we can see what's on the credit profile alongside this. Because if that $38,000 becomes a judgment, the conversation gets significantly harder. Paji, Florida. My score dropped 22 points and I genuinely did nothing. No applications, no new accounts, nothing. I checked my credit every month and I've never seen it move this much on its own. What is happening? Paji, I believe you, and I did nothing is actually a very useful starting point. Because the score moved, which means something changed, it just might not be something you chose to do. Here are the most common invisible causes. A creditor reduced your credit limit. You didn't ask for it. They did it unilaterally. The same balance on a smaller limit is a higher utilization, and the score reflects that immediately. A creditor closed an account you hadn't used. Inactive accounts gets closed. You lose available credit. Utilization goes up. Scores go down. Your statement closing date hit with high balance, even if you pay every month. What gets reported is the balance on the statement date, not the date you paid, the date the statement closed. Something new appeared, a collections, a notice, anything from an account you weren't actively tracking. Pull all three bureaus. Compare what's there now to what was there last month. The score is the reaction. Find the cause. Then you'll know what to do about it. Submit your question to the Real Credit Talk Show at beyondcreditlimits.com. Your first name and state, or anonymous. I read everyone. We started tonight talking about a relationship that one party thought was over, while the other was still processing the paperwork. And that's really what a short sale and a deed in lieu are. Not a clean break, a negotiated exit. And like every negotiated exit, what you walk away with depends entirely on what you knew going in and what you put in writing before you left. The deficiency that doesn't get waived because nobody told you to ask for it in writing. The approval letter with one sentence that reserves the right to come after you later. The 1099-C that arrives in January from a transaction you thought was behind you. None of those are random. All of them are predictable when you know what to look for. And now, you do. If episode 18 taught you anything, I hope it's this. Knowing the name of an option is not the same as knowing how to use it. And the people who come out of a housing exit with the least damage are not the ones who got lucky. They are the ones who understood what they were signing, what they could ask for, what January was going to bring, and what the next lender was going to read on the other side of it. That level of understanding doesn't come from Google. It comes from sitting down with someone who has been inside these situations with real people and already knows where the traps are. That's what the consultation is. And it starts at www.beyondcreditlimits.com. beyondcreditlimits.com. If tonight's episode connected to where you are, a short sale you're navigating, a deed in lieu you already completed, a credit file with entries you don't fully understand, or a next home that feels closer than your file currently says it is, Beyond Credit Limits was built for exactly this. Our credit report analysis looks at exactly how your exit is being reported, the account status, the remark codes, the date of first delinquency that determines the clock, any deficiency collection account that showed up after, what each entry means for your timeline and your next goal. Our strategy dispute processing addresses entries that are inaccurate, including short sales being reported as completed foreclosures. Through a structured, documented approach built around your specific file and your specific documentation. Our financial strategy planning takes your waiting period, your current profile, and your home ownership goal and builds the path that gets you there in the shortest realistic time. And our credit education and coaching walks you through what the waiting period requires. So you are not just eligible when the window opens. You're ready. 1 hour, your actual file, a real conversation about where you are and exactly what comes next. Visit www.beyondcreditlimits.com and fill out the consultation form today. The next home is not out of reach, but getting there requires understanding exactly what the last one left behind. Before I close, I want to leave you with this. No question is insignificant. Your questions matter because you matter. Knowledge creates options, and options create leverage. If tonight moved you, if something I said matched something you've been living, do not let that recognition just sit there. Act on it. Visit www.beyondcreditlimits.com and fill out the consultation form. Follow me on Instagram at The Real Credit Talk Show, Real Credit Talk Show, and at beyondcreditlimits.com. That's where I'm at. Come find me. And wherever you're listening from right now, Spotify, Apple Podcasts, iHeart, YouTube, hit subscribe and turn on notifications so you never miss when a new episode drops. Because every week on this show, we go somewhere most credit conversations never take you. And if tonight helped you, send it to somebody. Because right now, somebody in your circle is about to sign something without reading the sentence that matters most. Send them this episode. Submit your questions to The Real Credit Talk Show at beyondcreditlimits.com. Your first name and state, or anonymous, I read every one. And your question may be answered right here. This has been The Real Credit Talk Show, hosted by me, Tiana Mayers, Lady T, founder of Beyond Credit Limits Corporation. Visit us at www.beyondcreditlimits.com. And if you know the brand, you already know www.thatmerchmood.com. Until next time, keep learning, keep positioning, and keep moving with intention. Have a good night.